Hey guys, this is Compounding and welcome to my very first YouTube video. This video will focus on how to read charts and specifically how to read the Japanese candlesticks. This video will be the first of a two-part series about candlesticks and the patterns you can use to trade them. We will start with the absolute basics before moving on. So let's get to it. Today we will talk about the different chart types, Japanese candlesticks, their anatomy, body sizes and wicks, different time frames, and lessons learned with live chart examples. There are mainly three ways of indicating market movements and price: the line chart, the bar chart, and the candlesticks. They all have their own way of visualizing the movement of the market, each with their own pros and cons. The line chart. It's the most basic of them all. Line charts are very easy to look at and understand. The downside is that they don't offer as much information about the market's behavior as the bar and candlestick charts. I personally use only line charts to sometimes take a look at the big picture and identify clear trend breaks, as seen on this example. You can see a clear downtrend over here, with touch, 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 a break of the trend line, retest, after which the price moves up. Here you can see a clear uptrend with the touch of the trend line breaks, the price retests the trend line, got rejected and moved down. Here you can see again an uptrend, touch, touch, another touch. Here it went below the trend line, it's kind of a deviation, went back above the trend line but got rejected here at this resistance before moving down. Don't worry too much about trends, that's a subject for another video. Bar charts. They are a bit more difficult to read than the line chart, but they do offer more information about the market's movement. We won't dive deep into the bar charts because the Japanese candlesticks are basically the same, but it's an easier to read version. So, last but not least, the Japanese candlesticks. This is the chart type that is mostly used and where we will be focusing on in this video. They basically present the exact same information as the bar chart, but in a more pleasant way for the eyes. We'll dive deeper into them in a minute. A bit of history about the Japanese candlesticks. Well, scrap that. Let me show you first how to switch to the different chart types in TradingView. If you want to try them on your own, you can open your TradingView screen and select this icon over here. Select this arrow over here and you can see the different kind of chart types, the bar, candles, the line chart. If you select one of them, you can see how the charts change and you can switch back and forth to your own preference. So back to this presentation. A bit of history about Japanese candlesticks. They are used in Japan since the 17th century and were invented by Soki Honma. I don't know if I pronounced that correct, but who cares? And he invented them for tracking emotions of market participants. They were brought around 1989 to the US, and since then it became the standard template for analyzing charts. So why should we use them? Well, the Japanese candlesticks are the language of financial markets. If you acquire the skill of reading these candlesticks, you will understand what the market is telling you, and you will be able to make the right decision at the right time. It can help you decide when to enter, when to exit, and when to stay away from the market. Remember, there's a story behind each candle, and this is really important. Always remember that each candle is telling you a story. Learning to read Japanese candlesticks is like learning a new language, so of course it takes time. But with enough practice you will be able to instantly tell how the market is behaving based on these candlesticks. So, what actually is a Japanese candlestick and what do they consist of? Japanese candlesticks are formed using the open, high, low, and close of the chosen time frame. I will explain more about time frames later on. If the close is above the open, like you can see over here, we can say that the candlestick is bullish, which means that there are more buyers than sellers at this price, and thus the price is rising. Bullish candlesticks are mostly displayed as green candlesticks, but you can customize these to your preference. If the close is below the open, like we see over here, we can say that the candlestick is bearish, which indicates that there are more sellers than buyers at these levels, resulting in downwards price movement. A bearish candlestick are mostly displayed as a red candlestick. So we have the filled part of the candlesticks, which is called the real body. The thin lines poking above and below the bodies are called shadows. And the top of the upper shadow is called the high, and the bottom of the lower shadow is called the low. We'll get into more details in a minute, but let's first move on to the body size itself. Because candlesticks have different body sizes. On the example you see a green bullish candle over here with a relatively large body size. Next to it you see a red bearish candle with a smaller body size. Long bodies, like the green one on the left, refer to strong buying pressure in case of a green candle and strong selling pressure in case of a red candle. So for example, if you see a green bullish candlestick, it means that buyers are stronger than the sellers and that they are taking control of the market. The same applies for bearish candlesticks, with selling pressure of course. When you have a short candlestick body size, like this red one, it means there is little buying or selling activity. In this case, because it's a bearish red candle, selling activity. We will look at some examples on the chart later on. So now that we know what the candlestick's body size tells us, let's take a look at the candlestick shadows, or some call them wicks. The upper one, this one, and the lower one can show us information about what happened during the formation of that candle. Upper shadows show us a session high, and lower shadows show us a session low. If you spot a long tail, like this one, it tells us that the price has moved down all the way to here before the price closed, and the body is definitely formed. If you see short shadows, it shows us that the most of the trading action was close to the open and close price. This is a good example because you see the wicks are really short compared to the body size itself. So most of the trading happened close to the open and close price. So how can we use this information in our trading? Well, if a candlestick has a long upper shadow and a short lower shadow, like here, a long upper shadow and a short lower shadow, it means that the buyers showed their muscles and moved the price all the way to this level before the candlestick closed. Sellers stepped in and pushed the price all the way back to here. This is a bearish indicator, and you can see after this has formed, the price moved down. If the candlestick has a long lower shadow and short upper shadow, like here, this means that sellers showed their muscles and moved the price all the way down to here, but buyers stepped in and drove the price back up. So that means there are a lot of buyers standing by to buy at these prices. Bullish indication, and you can see that after this candle has formed, the price moved up. Time frames. I've already mentioned it a few slides before this one, but a candle represents the trading activity for a specific time frame. For example, if you choose the 1-hour chart, one candle represents 1 hour of buying and selling activity. That 1-hour candle consists in turn out of lower time frames, like for example the 2 candles of the 30-minute time frame. For beginners, I always recommend to start with higher time frame trading, such as the daily and the 4-hour time frame. There is just less noise on these charts. I personally use a combination of the daily, 4-hour, 2-hour and 1-hour for most of my trades. We will discuss more about time frames and things like support and resistance in another video. Time for lessons learned and for me to show you some examples on a live chart. We'll talk about candlestick anatomy, the body size, the shadows and wicks, and time frames. About the candlestick anatomy, you can see all different kinds of candles over here, and you see the body of the candle with the upper wick and a lower wick. The candles are also different sizes, so we can see a few large body size candles over here, which means there is much buying pressure going on, and this is a strong upwards movement. You can see here and here just above support that the body size itself isn't that large, which means there isn't that much buying or selling pressure. You can see 2 relatively large wicks over here and here. How can you use that in your trading? Well, the price moved down to here, followed by a bit of indecision above support level. Support established over here, and on this last candle, the sellers tried to push the price down below the support, trying to break it. But the buyer stepped in, moved the price back up above support. It closed above support, indicating a bullish signal. Buyer stepped in, pushed the price upwards. So this long tail, this long wick below the support is a bullish indicator, because the sellers didn't manage to close below the support. Price went up, established a new support over here, which broke down on this candle because it closed below the support. Price moved down, retested the support that was established over here, bounced, went back up to test the previous support, now turned into resistance. You can see that the buyers tried to break the resistance by pushing the price all the way to here. But sellers stepped in, pushed the price back down inside this range, and when the candle closed inside the range, it was a push the price back down inside this range. So this is a bearish indicator because the price went through resistance, but went all the way back down into the range again and closed below the resistance. And as you can see, the price moved down afterwards. You could use this kind of price action to really get some nice setups. You could open your long over here after seeing the price closed above the support, with your stop just below this wick. The target over here. And in this case, you would short the market, put your stop above this wick and target the support. And that will conclude the first video. Like I said before, this is the first video of the 2 videos on the subject candlesticks. and the next one will focus on candlestick patterns and how to trade them. Thank you all for watching. Hope you learned something, and make sure to subscribe to my YouTube channel and Twitter to support the channel and to get notified as soon as I post new content. Thanks again, keep learning, stay positive, and you will become a successful trader.